Hey there. So you're looking to boost that dividend stock portfolio, and you've got your eye on these two companies, Coca-Cola and Home Depot. Yeah. This article titled Two Dividend Stocks to Double Up On Right Now. Well, it really piqued your interest. And frankly, mine too. They haven't exactly mirrored the S&P 500's performance this year. But that could signal an opportunity, right? So let's dive in and see what's really going on with these two.
It is an interesting situation, for sure. Both companies, household names, practically synonymous with their industries. But their recent stock performance, it might make you wonder if their best days are behind them.
Yeah, especially with Coca-Cola. I mean, they've been around for over a century with a portfolio of drinks that are just globally recognized. I mean, you'd think they'd be immune to market fluctuations, right? But the article points out some revenue struggles, particularly with sales volume being down, which is a bit puzzling considering they've raised prices. So what's your take on that?
Well, inflation is a big factor here. You've probably seen it yourself. I mean, prices for everything are going up, and that's putting a strain on consumer spending. People are having to make choices about where they spend their money, and sometimes those iconic red cans of Coke, they get left on the shelf.
It's interesting, though, because it's not just about inflation, is it? I mean, consumer preferences are always evolving. So are there other factors at play here? Could it be competition from other beverage companies, or maybe a shift towards healthier options?
You're hitting on a key point there. It's rarely just one factor impacting a company's performance. It's a complex web of influences. In Coca-Cola's case, they are facing increasing competition from smaller, trendier brands, especially in the health and wellness space. And yes, the shift towards healthier drinks is definitely having an impact. They've tried to diversify, venturing beyond just sugary sodas, but it's a constant battle to stay ahead of those changing tastes.
Okay, so that's the potential downside. But let's not forget, we're talking about Coca-Cola here. They're a Dividend King with a 62-year streak of dividend increases, a reliable 3% yield compared to the S&P 500's 1.2%. That's got to be tempting for any dividend investor.
Absolutely. And their payout ratio shows they can comfortably afford those dividends. They've even got another increase likely coming soon, typically in the first quarter.
But here's the thing. Even with that impressive history, you can't just assume those dividends will continue to flow forever.
You're right. It's not a guarantee.
Yeah.
So how can you, as an investor, look past those impressive dividend numbers and really assess the long-term viability of a company like Coca-Cola?
You've got to look beyond the headlines. Yes, inflation is a factor. But how is Coca-Cola adapting to it? Are their diversification efforts successful? Are they effectively navigating those changing consumer preferences? Those are the questions that will tell you if those dividends are truly sustainable. All right, that's a lot to consider with Coca-Cola. Let's shift gears to Home Depot. I mean, they're the giants of home improvement, with annual sales dwarfing their rivals. But they've hit a bit of a snag recently, haven't they?
Yes, their sales have slowed down, and there's a very clear link to the current state of the housing market. Rising interest rates have made mortgages more expensive, which cools down home buying and consequently renovations.
So it's not that people suddenly stopped needing hammers and paint. It's that the entire ecosystem around home improvement has been impacted. I see the connection. But wouldn't you say their size and market dominance still offer some level of security?
It definitely plays a role. Home Depot has a strong track record of navigating economic downturns. But even they aren't immune to a slowdown in the housing market. Think about it. Fewer people buying houses means fewer people needing to furnish them, renovate them, and so on. It creates a ripple effect that impacts their entire business.
It's all connected, isn't it? This makes it even more important to understand these economic factors.
Exactly. And when it comes to Home Depot, understanding those factors means understanding the housing market. Are interest rates going to continue rising? Will inflation ease up enough to give consumers more spending power? Those are the key variables.
That makes sense. The article did mention that mortgage rates are showing signs of stabilizing and that home sales actually ticked up in October. Could that be a sign of things to come?
It's certainly a data point worth watching. If that trend continues, it could bode well for Home Depot. But we need to see if it's a blip or a sustained recovery. It's too early to call it a definitive turnaround just yet.
Okay, so we've got this potential for a rebound, but it's still early days. Let's talk dividends. Home Depot's been pretty reliable there too, haven't they?
They have. They've increased their dividends annually since 2010 and even held them steady during the 2007-2009 recession, which really speaks to their commitment to shareholders.
Yeah.
It does. Their financials back up that commitment. Their free cash flow for this year was $12.8 billion, and they paid out $6.7 billion in dividends. That's a healthy ratio, indicating they have plenty of financial breathing room to support those payouts. Their current dividend yield is 2.1%. which is quite attractive in the current market.
So we've got these two companies here, both facing some headwinds, but both with solid track records of dividend payments and potential for growth if those headwinds ease up. It feels like a classic high-risk, high-reward scenario, wouldn't you say?
It's definitely a balancing act. You're weighing the potential for future growth and continued dividend payouts against the uncertainty of the current economic climate. And that's where you as an investor need to do some digging.
Okay, let's talk about that. What are some of the key things you should be looking at when trying to assess the risk versus reward in a situation like this?
First and foremost, you need to understand that past performance is not a guarantee of future results. Just because a company has consistently paid dividends for years doesn't mean they're invincible. Economic conditions can change, consumer preferences can shift, and new competitors can emerge.
So how do you look beyond those impressive dividend numbers and really get a feel for the company's long-term prospects? What are some indicators you should be paying attention to?
Well, you've got to look at the bigger picture. We've talked about inflation and its impact on consumer spending. That's a key factor for both Coca-Cola and Home Depot. But you also need to consider how well each company is positioned to navigate those challenges. For Coca-Cola, are they successfully diversifying their product line to cater to evolving consumer tastes? For Home Depot, how dependent are they on a robust housing market? These are the types of questions you should be asking.
It's not just about the dividend yield. It's about understanding the underlying factors that drive a company's success.
Precisely. And you also need to consider the broader economic landscape. Will interest rates continue to rise, potentially putting a further damper on the housing market? Will inflation moderate, giving consumers more breathing room? These macroeconomic factors will play a significant role in shaping the future of both companies.
This is where it gets really interesting. You're not just looking at company financials, you're analyzing global trends and trying to anticipate how they'll play out.
Exactly. It's like putting together a puzzle. You've got all these pieces of information, and you're trying to figure out how they fit together to create a complete picture. And remember, there's no one right answer. Different investors will weigh those factors differently, based on their own risk tolerance and investment goals.
So we've covered a lot of ground here. We've talked about economic challenges, potential for growth, and the importance of looking beyond the dividend yield. But let's bring it back to our listener. What are the key takeaways they should be walking away with today?
Well, first and foremost, they need to remember that investing, especially in dividend stocks, is a long game. Don't get caught up in short-term fluctuations. Instead, focus on identifying companies with a solid track record, a sustainable business model, and a commitment to rewarding their shareholders.
That sounds like a good starting point.
And they need to understand that there's no such thing as a risk-free investment. Even companies with impressive dividend histories like Coca-Cola and Home Depot can face headwinds. The key is to assess those risks, weigh them against the potential rewards, and then make an informed decision.
So it's all about due diligence, understanding the factors at play, and making a judgment call based on your own investment strategy.
Absolutely. And finally, I'd remind them of the importance of diversification. Don't put all your eggs in one basket. Spread your investments across different sectors, industries, and asset classes to mitigate risk and create a more balanced portfolio.
That's sound advice for any investor, regardless of their experience level. So you've heard it here first, folks. Do your research, understand the companies you're investing in, and don't be afraid to ask questions.
The more you learn, the better equipped you'll be to navigate the ever-changing world of investing.
Couldn't have said it better myself. Now I'm curious, given everything we've discussed today with these two companies, is there anything in particular you'd be watching closely if you're considering investing in either Coca-Cola or Home Depot?
That's a great question. And it really highlights the importance of staying informed and adaptable as an investor. For me, it would be interest rates. They're the linchpin for so much economic activity, especially in the housing market, which directly impacts Home Depot. With Coca-Cola, it's less direct. But if rates stay high or climb even further, it could squeeze consumer spending even more, making those discretionary purchases like a Coke at the store even less likely.
That makes a lot of sense. Yeah, I'd probably be glued to inflation reports myself. Watching how those price increases are trending would give me a better sense of whether consumers are regaining their spending power or if they're going to continue tightening their belts.
That's a smart approach. It's all about understanding those interconnected pieces of the economic puzzle and how they might impact your investment decisions.
Absolutely. Well, we've certainly explored a lot of those pieces today, haven't we? We've looked at the challenges facing Coca-Cola and Home Depot, analyzed their dividend histories, and even delved into the complexities of the housing market and the global economy, all with the goal of helping you make a more informed decision. about whether to double down on these dividend stocks.
And remember, it's not about finding the right answer. It's about gathering the information, weighing the risks and rewards, and making a choice that aligns with your own investment goals and risk tolerance.
Exactly. So as you continue your research, keep those factors in mind. Pay attention to the news, keep an eye on economic indicators, and most importantly, don't be afraid to ask questions.
The more you learn, the better equipped you'll be to navigate the ever-changing world of investing.
Couldn't have said it better myself. Well, we hope this deep dive has given you some valuable insights and a fresh perspective on these two companies. Good luck out there on your investing journey.